All right, welcome to the 40 Finance channel. It's been a rough few weeks here for the stock market. So I thought it'd be interesting to kind of take a contrarian view, or at least look to a potential contrarian, and that would be Tom Lee of Fundstrat, who's well known as a perma bull. What does Tom Lee think of the current situation? If you look just at the QQQ on a year-to-date basis, it's only down 6% or so from Jan 1, but there are several stocks within the QQQ that have been chopped by considerably more. And so to me, it's a good time to check in with a guy who's generally bullish and see where he stands because he's made so many bullish calls. How has this past few weeks changed his opinion? Has anything changed? And where does he see things going in the future? All right, now we'll kick things off with Tesla because Tom Lee's been a pretty big supporter of Tesla stock for, at least a few years now that I can remember. But Tesla stock's had one of the bigger haircuts in the QQQ. So year to date, this one's down 38%. But most long-term supporters of Tesla will point to a different runway with the autonomous vehicles, things like that, taxi systems, and how Tesla might have a leg up in that department. But if we look specifically at Tom Lee and what he says about this big drop, this is from March 8th. This is a quote from his appearance on a show called The Compound, which you can see, you can find on YouTube. And to put it succinctly, this tweet, I think, does a good job. In Tesla's case, it's not like their competitive position has worsened. It's probably strengthening. And within that same interview, Tom Lee also brings up the fact that, the president and the Fed, they're not going to just let a recession take hold without at least fighting it or pulling some tricks out of their sleeve. And speaking of surprises or the unexpected, you had on March 11th, President Trump basically having a Tesla advertising summit. And with this, Musk got to speak for a minute and talked about bringing jobs and production back over to United States soil. And if we go back to Tesla stock, now today's a better day in the market in general, but you have an uptick of 7% here early on March 12th. Now, that's a combination of both the market bouncing back on some CPI data, but I'm sure the White House appearance didn't hurt any as well. So bottom line with Tom Lee, he appears to be staying strong in his support of Tesla. And he goes on to say, we talked about the support levels, that Tom does not think the government will let things sink much further. And he was on Squawk on the Street, I believe it was yesterday at 10 a.m. And here's a couple points that he posted on his own Twitter account. Equities under intense selling pressure. White House warns of pain ahead, reminiscent of Fed Chair Powell at Jackson Hole in August of 2022. The selling appears to be indiscriminate and far more severe in stocks than corporate bonds. Bottom line, despite public statements, neither the White House nor the Fed want a recession. So I interpret that as Tom Lee basically saying that the White House and the Fed aren't going to let a recession happen no matter what it takes. So the people that are selling what he calls indiscriminately and bailing out of the market could miss an opportunity when they think they're getting ahead of a storm. Now, another interesting position that Tom Lee holds right now is that interest rates are far more important than anything you'll see on the tariff side. He's called out multiple times that tariffs are a bargaining chip and that they could waver. What you see today, and we've already seen this in the news, when you hear about severe tariffs on Canada, all of a sudden, the next headline 24 hours later is those are on pause because the two sides are going to come together and talk. So the tariff scare might be overblown, if you believe in Tom Lee's opinion, because what we see in the news today may not evolve into reality down the road. Furthermore, he makes a point on a recent video where he says that millennials, aka 40% of all home buyers, care more about interest rates than tariffs, And this fact by itself highlights the importance of the 10 best days every year in the market. Now, when it comes to the rates, there's a transcript here. You don't have to read it. I'm just highlighting it so you can see the actual points. If we had to look at what's happening in the economy, interest rates have fallen because of tariff concerns. It's probably more important for millennials that interest rates are falling, not tariffs. And in some ways, I think as much as the market is concerned about tariffs, it is a bit short-sighted. Now, throughout the video, he used the millennials as one of the most important segments to the U.S. economy in terms of consumer spending. And he calls out at the end, if you look at financial services specifically, millennials are going to be 72% of all spending growth, whether that's insurance products, mortgage interest rates, charges, vehicle insurance, contributions to IRAs, people paying finance charges on cars, life and personal insurance. So you get the picture. Basically, when it comes to financial services, the millennials are the most important consumer right now, and all they care about is interest rates. So with that, let's think about interest rates. And Tom Lee made a point on a recent appearance on CNBC, and I just highlighted here. If the job market's soft, the Fed put comes back into play because the Fed doesn't want to deal with stall speed. I think that's what's going to be the positive catalyst in the next couple weeks. On top of that, we already know stocks will bottom before bad news peaks. And the bottom line there is, if things continue to erode, then you start talking about the Fed cutting interest rates. And that's exactly what Tom Lee sees happening as we go forward. And interestingly enough, the sentiment for Fed cuts or projections for Fed cuts for most of the analysts on Wall Street land in May. They say in May, at the FOMC meeting in May, there's a strong chance we could see some type of cut in interest rates. And just the possibility of Fed cuts or general government intervention brings up Tom's other point he's been talking about recently, which is the 10 best days in the market. So if you think that there is going to be intervention, or you think that things are going to turn around, you can't afford to miss the 10 best days of the stock market. And just to highlight that, Tom Lee says last year, for instance, the 10 best days added up to 21 percentage points of the S&P. Without those 10 days, the market was only up 4%. So you don't get 20% growth years because it's good throughout the year. It's really just the 10 best days. I think the setup for a 10 best day is near, because if the economy's near stall speed, I think people realize the Trump put does come back, because otherwise it has to unwind all this austerity. And if the job market's soft, the Fed put comes back into play, and that bleeds into the quote we started off earlier. And here just this morning on the Fundstrat website, Tom released a video. The summary is simple. This 10% correction is the fifth fastest in the last 75 years, and history argues that this is indiscriminate rage selling. And within here, he highlights several things. I'll cherry pick. We know the reasons stocks are down: tariffs, economic weakness, etc. We think corporate bonds have held up due to the Fed put coming back into play. We know this because the odds of a May cut are now 54% versus the 10% we saw in January. And 3.4 cuts are priced in 2025 versus Fed guidance of 2 cuts. And I mentioned that before, but those are the actual stats behind the change in sentiment and the fact that more people are starting to expect more cuts from the Fed as the year goes on. And if this happens, you don't want to miss out on the 10 best days of the stock market. And considering the year we've had, particularly the past 3 weeks we've had, I would say the 10 best days are likely ahead of us. I'd guess Tom Lee certainly believes that as well. All right, so where does this all land? If you are Tom Lee, you're still believing in Tesla despite its meltdown. You think that basically tariff talk is overblown and could certainly pull back over the next several months since it's really just a bargaining chip. You also think that the clamor for reduced interest rates is starting to get stronger and stronger, and the odds of interest rate cuts are increasing, which would be a huge boom for the millennials who make up the better part of consumer spending. And that, of course, would unlock another leg up in the economy. Well, if you put all those things together, the actual quote is, I think it's very possible that March, April, May could actually be one of these huge rally months where we're rallying 10 to 15%. That's Tom Lee as quoted by Fortune. All right, so that's a few things Tom Lee has been talking about as a perma bull during this time of weakness in the stock market. How much of that do you think is going to turn into reality? And are you feeling good about the next 3 months or so in the stock market? Are you buying now or simply just holding on to see that potential 10 to 15% gain that Tom Lee is calling for if all of the dominoes fall correctly? Quick shout out before we go. If you're interested in learning more about Seeking Alpha Premium, which is the stock research platform you see on your screen there, something I use all the time, check out the description for a link to get a free trial, 7-day free trial, as well as $30 or so off of your annual subscription. Hope everybody's doing well. We'll see you on the next video.